Right now, something is happening to your money. Not loudly, not dramatically, but quietly. Every year, prices rise. Groceries become more expensive. Fuel costs increase. Housing becomes harder to afford. Daily living slowly becomes heavier on your finances. This is inflation. And while most people only notice it when things become painfully expensive, the real damage has already been happening for years. Because inflation doesn't just increase prices, it slowly weakens the value of the money you've already earned. The savings sitting in a bank account, the cash waiting for the right time to invest, the income that once felt comfortable. If that money is not positioned correctly, inflation quietly reduces its purchasing power year after year. And that's the hidden danger. The wealthiest and most financially aware individuals understand something most people overlook. Protecting your wealth during inflation is not about reacting after prices rise. It's about quietly positioning your assets before inflation spikes. There is a quiet asset management strategy that allows disciplined investors to protect their purchasing power, strengthen their financial foundation, and continue building wealth even while the cost of living climbs. It's not loud, it's not flashy, but it is incredibly powerful. In this video, you're going to discover how this quiet strategy works, why inflation catches most people unprepared, and how positioning your money the right way can protect your financial future. But stay with me until the end of this video, because the final principle I'm going to share is the one that separates people who slowly lose financial ground to inflation from those who quietly protect and grow their wealth while the economic environment around them becomes more expensive. The silent threat of inflation. Inflation rarely feels dangerous at first. There are no alarms, no dramatic warnings. Prices simply rise slowly over time. Groceries cost a little more. Fuel becomes more expensive. Housing payments increase. Everyday expenses quietly climb. At first, it may seem manageable, but over time, something important begins to happen. Your money slowly loses purchasing power. The same income that once covered your lifestyle begins to stretch thinner. And if your savings are sitting still, inflation quietly reduces what that money can actually buy. This is why simply earning money or saving money is not enough to protect your financial future. Money that remains stagnant loses strength over time. Financially disciplined individuals understand this. They don't just save money. They position their money in assets designed to grow, produce income, or adjust with economic conditions. Because inflation is not an occasional event, it is a recurring part of modern economies. And the people who protect their wealth are the ones who prepare their financial strategy before inflation becomes obvious to everyone else. The goal is not panic. The goal is positioning, because once your money is positioned wisely, inflation stops quietly eroding your progress. Your financial system becomes strong enough to withstand it. Why most people lose ground during inflation? Many people believe that working harder automatically protects their finances. They focus on earning more income, saving more money, and maintaining stability. But during inflationary periods, income alone is rarely enough to maintain financial strength. The real issue is how money is positioned. One of the most common financial mistakes is allowing large amounts of money to remain idle. Cash that sits untouched in accounts may appear safe, but if prices continue rising, that money slowly loses purchasing power. Over time, the same savings begin buying less and less. Another problem is reacting emotionally to economic headlines. When inflation becomes obvious, many people rush into decisions without a long-term plan. Some panic and move their money repeatedly. Others delay investing entirely because uncertainty makes them uncomfortable. Both reactions weaken financial progress. A third challenge is lifestyle expansion. As income increases, spending often rises at the same pace. Instead of strengthening their financial base, many individuals increase their living costs. When inflation pushes prices higher, those higher expenses become even more difficult to manage. Financial resilience requires a different approach. It requires recognizing that money must remain productive. Assets that grow, generate income, or adjust with economic conditions help maintain financial strength when the cost of living rises. This is where a quiet asset management strategy begins to make a difference, not through dramatic moves, not through risky speculation, but through thoughtful positioning designed to protect purchasing power over time. The quiet asset management strategy. Protecting wealth during inflation is rarely about dramatic financial moves. The most effective approach is often quiet, disciplined, and consistent. It begins with understanding that money should not remain idle for long periods of time. Productive assets are the foundation of long-term financial stability. Assets that grow in value, generate income, or adjust alongside economic conditions help maintain purchasing power when prices rise. Many financially disciplined individuals focus on building a balanced mix of assets rather than concentrating everything in one place. Diversification helps reduce vulnerability to sudden economic shifts. Different types of investments respond differently to inflation, interest rates, and market conditions. When assets are spread across multiple areas, financial systems become more resilient. Another key element is consistency. Instead of trying to predict the perfect moment to invest, disciplined investors often focus on steady contributions over time. This approach reduces emotional decision-making and allows long-term growth to compound gradually. Compounding is powerful because it allows investments to generate returns that then create additional returns. Over long periods, even moderate growth can become significant. Finally, patience plays a critical role. Inflation, markets, and economic cycles move in phases. Short-term fluctuations can create anxiety, but long-term positioning often produces stronger outcomes. A quiet asset management strategy does not rely on reacting to every change in the economy. It relies on structure. When assets are positioned thoughtfully, financial systems remain stable, even as the economic environment shifts around them. The mindset that protects wealth during inflation. Protecting wealth during inflation is not only about the assets you own, it is also about the mindset guiding your financial decisions. Economic uncertainty often creates emotional pressure. Headlines become dramatic, markets move unpredictably, prices rise faster than expected. During these moments, fear and impatience can easily influence financial behavior. But disciplined investors approach these periods differently. They focus on long-term financial direction rather than short-term noise. Instead of reacting to every economic update, they remain focused on structure and consistency. This mindset allows them to continue investing, improving their financial position, and strengthening their asset base even when economic conditions feel uncertain. Another important part of this mindset is understanding that inflation and economic cycles are not unusual events. They are recurring patterns in modern economies. Prices rise, markets adjust, policies change, and new opportunities eventually emerge. Individuals who remain calm during these cycles are often able to make clearer financial decisions. Patience becomes a powerful advantage. When decisions are guided by long-term thinking rather than temporary fear, financial progress becomes far more sustainable. Over time, disciplined positioning, steady investment habits, and thoughtful asset management create a foundation that remains stable even when the economic environment becomes more expensive. This stability allows wealth to continue growing while purchasing power remains protected. Because in an inflationary world, the strongest financial position is created not through reaction, but through preparation. Protecting your wealth in an inflationary world. Inflation will continue to be part of the economic landscape. Prices will rise. Currencies will fluctuate. Markets will move through cycles of expansion and pressure. These changes are not unusual. They are recurring features of modern economies. The difference between financial struggle and financial stability often comes down to preparation. Money that remains stagnant gradually loses purchasing power. Money that is positioned in productive assets has the opportunity to grow, generate income, and adjust with changing economic conditions. Protecting wealth during inflation is not about reacting to every economic headline. It is about building a financial structure designed to remain resilient over time. A balanced mix of assets, disciplined investment habits, controlled spending, and long-term thinking can create that resilience. When these elements work together, financial progress becomes far less dependent on short-term economic fluctuations. The goal is not perfect prediction. The goal is consistent positioning. And consistent positioning allows wealth to remain stable even while the cost of living continues rising. If this video helped you think differently about protecting your money from inflation, share your thoughts in the comments and let me know what strategy you are focusing on to strengthen your financial future. And if you want more insights on financial education, wealth building strategies, and long-term money management, subscribe to Financial Awaken with Aaron and hit the notification button so you don't miss the next video. Because every week we break down practical ideas that help you build financial awareness and create stronger financial foundations. Thanks for watching. I'll see you in the next video.